I'm actually going to post in the Facebook group a link to like that chat thing that people can make sure that's in the Facebook group real quick. Yeah, there we go. So if you are watching right now, well, nobody's watching yet, but when you start watching, there is a link at the top. I guess I got to wait for people to jump in here, but there's a link in the Facebook group, Tax Smart Investors Facebook group. Click that link, and like what we would like to do is be able to show comments like this. Actually, I guess here like this. So this can only happen. So the Facebook group is like doesn't push out to Restream or really any other platform. So whenever somebody comments from the Facebook group on our live stream, it just shows up as like anonymous Facebook poster. So if you want us to, what we would like to do is we would like to share your comments here as we talk about them, like on the screen itself. And we'd love for your name to pop up next to them. So if you want that to happen, if you're in the Facebook group, go click that link, that chat.restream.io. It's just for the Facebook group people. YouTube, you guys come in fine, so we can see your name and everything. But if you're in our Facebook group, click that. It'll ask you, do you want to connect to Restream? Just click yes. And that way, when you ask a comment, we get your name and we can post it up there while we're talking about it. But we have Justin with us. I guess we should introduce Justin. Justin, tell us a little bit about yourself.
Yeah, hey guys. So I've been investing in real estate for 6 or 7 years now, and just always been drawn to it for all the big tax benefits. And I started following these guys about a year ago because the podcast was just so phenomenal. I got sucked right in. So, I've been advising on taxes with real estate investors here in my local area for quite a few years now. So it's been a joy. I've joined the team recently, and now I get to working with these guys. So
yeah. So Justin, you've been on our radar for a while, but then when we saw you, so Justin was posting in the Tax Smart Investors Facebook group quite a lot before he joined our company, and Tom and I were going, man, we should try to get this guy to come work for us. What do you think it's going to take? And so I think that, right? Tom, you reached out to Justin originally, or did
Justin reached out to us? He reached out to us.
Yeah. So we're happy to have you. So Justin now works for the Real Estate CPA, locked in another strong advisor, which we're excited about. So you'll see him posting. He's been posting, but you'll see him continuously posting in the Tax Smart Investors Facebook group. And you'll see that moderator tag next to him, so you know that he's a legit member of the team. But and do you have bourbon tonight, sir?
I do. It's I don't know if it's up for debate on the whiskey versus bourbon, but I thought I would try and represent the Midwest here. So I've got this Kansas City City whiskey. Nice. Pick that something a little bit different there, and
very good. Tom, what are you drinking tonight?
Still drinking the Maker's Mark.
Still chipping away at the
trying to kill the. Look, hold on, let's see. Can you guys see right there? Kentucky straight bourbon. What?
Yeah, but it says whiskey. It's like the whiskey just kind of like. It's like more than the bourbon. I don't know, man. I don't know. Whatever, maybe we should have everybody vote on it. Like, is Maker's Mark real bourbon? Yeah, but I told this story before, but I'll tell it again. So I went on a couple of bourbon tours in Kentucky. Really cool. If you haven't gone, you have to go. But we went to the Maker's Mark facility, and they hand dip. There's like 3 or 4 women there that just take the bottles out of the assembly line. They hand dip it into the wax. They like roll it, and then they put it back on the assembly line. And I thought that was really cool, because I'd always wondered how they got the wax to drip down like they do. So it's a neat experience. If you do go on the bourbon tour, make sure you go to Woodford, because they give you pretty hefty pours. And so also make sure that you don't drive to Woodford or that you have somebody that can drive for you. because you will not be leaving there standing. That was good. It was a fun time. All right, so tonight we're going to talk about the Biden tax plan, what dropped last week, and what you should do today to mitigate your exposure to the upcoming Biden tax plan. And then we're also going to talk about the $25,000 passive loss allowance, and I'll tell you why whenever we get to that. But that should be a good discussion. We have a Facebook user. See, this is see how it just says Facebook user. So if you want us to be able to show your name, go scroll up and click on that link chat.restream.io, and it'll just ask you to connect to Facebook, and then I'll be able to show your comment, and your name will pop up. And I agree, Buffalo Trace is an amazing tour. Really liked that one. And I believe Pappy, right, is Buffalo Trace. Isn't Pappy Buffalo Trace? I think Pappy's Buffalo Trace. Pappy is like the $2,000 a bottle for bourbon. Yeah. Anyway. All right. Let's hit the Biden tax plan. So, Justin, did you ever get a summary from us on that, or we jump on you here?
No, you're just plunging me right in with the sharks, you know.
Okay, sorry, man. Sorry. All right. Well, the Biden tax plan, pretty vanilla at this point. Although I did see that. I did see that Manchin, I think is how you say his name, right? Manchin was still pushing back on it. So I don't even know if this round's going to pass. Yeah, I was reading that this morning or yesterday.
This was tame, and this was a tame round. When I saw that, I was like, "Well, what are they really changing?
Yeah,
they're changing too much."
Yeah. So we released a podcast episode on it. So if you want the full download, go to the Real Estate CPA podcast, the episode that we released today. But what wasn't in it was 1031 exchanges and stepped up basis, which is good, right?
That's fantastic.
Yeah, because that was worrying real estate investors. And I mean, the stepped up basis, that's a big deal when you die. You want your kids to be able to inherit your wealth and not pay tax on it. And stepped up basis was talked about at the beginning of this year. Everybody's freaking out because they were going to basically eliminate this rule that you can pass real estate down to your heirs and not have them pay tax on it, tax on the gain.
They were going to do worse than that. They wanted to make they wanted to make death an unreal. They wanted to tax you on the unrealized gains of death too, which was a whole nother issue.
Right. Mm-hmm. I forgot about that.
Yeah, they were trying to get really aggressive.
Yeah.
For all the people I talked to, in this last year or so, that were senior citizens and whatnot, and really built that into their plan as part of their succession planning, was the step up in basis. And I was getting a lot of frantic calls, earlier this year of, are they really going to do away with that? And he gave the usual answer, don't have a crystal ball. We'll just have to wait and see, but hopefully not.
Yeah. So what do you do when they do that though, Justin? Like what do you say when people, because we had the same thing. A lot of people calling us up worried. So what did you do?
The first thing that I would usually at least breach with them was, whether or not there would be any alternative planning options for them as far as, if that does pass, what does a disposition look like, and, if it's something like it's a $1.5 million gain on the property, are there alternative options we can consider, like an installment sale, maybe just to at least bring it down into a lower capital gains bracket or something along those lines. And then also, discussing, things like 1031 exchanges, but of course, if it's for end of life planning, that's not really applicable either. So, I was just trying to give them that, there may be some options too, but we'll just have to wait and see.
Yeah. I started laughing because you did a lot more than we did. We were just chill, chill, just relax, man. We don't know what's gonna get passed. Let's not make any hasty decisions until we get at least a proposed bill.
I was going to say, what I did, I told a lot of people that I knew would not, it's like, yeah, take it with a grain of salt kind of thing it's, Tom, I've heard you use this phrase a few times before too, but what I told him is that I would anticipate, or hopefully it would get worked out of the bill, because there were other bigger items on the chopping block. And frankly, I think it's hard for a politician to get on TV, like on CNN or something like that, and try to explain what they're trying to accomplish with eliminating the step up in basis. It's a lot easier for them to get up there and say, we're going to tax the rich, or we're going to get rid of capital gains, than it is to try and explain what it means to eliminate something like a step up in basis. So it's not a sexy conversation. Like, it's not exciting, and they lose the attention base, I think. So I was just hoping from that fact that they'd go after easier targets than step up in basis. But
I mean, you're right though. Like, they don't have to explain what step up in basis is. They just say we're going to tax the rich, and that's enough, right? It's just marketing.
It's a trigger point. I mean, you'd be surprised how many people, like the average person, not anybody listening to this, of course, because everybody's in the know here, but the average person has no idea what's going on half this stuff. You talk to the average person about this, and it's in one ear, out the other. They're like, whatever. So, you can't sell complex ideas to the public, unfortunately. You have to keep it really simple and dumb it down tremendously.
So I know an investor that sold her property because she wanted to get ahead of the curve of this long-term capital gain curve. And then in the September bill, they made the September bill included the long-term cap gains, like increasing, I think, to some. I think it was only like a few points, but they made it retroactive to the date that like Biden announced that they were going to do that, which was back in April, right? so this person went and sold her property to avoid this long-term cap gains. Then it was made retroactive, and then in the bill that was dropped last week, long-term capital gains aren't even in there. There's no increase. No, they're not even touching them. So she sold her property to avoid this tax that no longer exists. That's why we say chill, just chill. Grab a glass of bourbon and just relax.
and you know something too about the 1031 exchange. Do you know, like, in almost every single tax proposal that I've ever heard of, it's been on the chopping block, but every single time it never gets completely eliminated. And from my understanding, the 1031 exchange industry has an excellent lobbying. They must have a consortium, or what's the one I'm looking for? Is a word with a C. I can't.
Cohort.
They have something. They have a good lobbying. They have a good lobbying fund or something.
What are other words that start with a C?
The consortium, is that what?
Consortium. Conglomerate.
No.
It's
constituents.
Something with it's like a group of people.
We're not moving on here, so everybody that's watching right now, you got to help us right now. Tom's struggling. We got to get into
I'm struggling.
Whatever C word he's looking for.
I'll get off this webinar. I'll literally walk. Not webinar. I'll walk outside of this room, and all of a sudden it'll be like, boom, it'll come to my mind.
Yeah, but I mean, the other thing with that is kind of like what you're saying in that example. I also just told people in general is like, this is not the time for knee-jerk reactions, because for exactly that reason. I mean, most of the time, I feel like, again, my experience, the majority of the time, we get a little bit of heads up when changes are going to be made. It's uncommon, I feel like, for things to be retroactive, unless it's something positive like child tax credit or something. A lot of times they'll want to make that effective immediately or retroactive. But but in the event that they actually do make something retroactive, you don't want to have locked yourself into a position because you made a decision before you had all the information.
Yeah, 100% agree. What else was not in the bill, Tom? There was the IRA. That was the bill.
Yeah, the IRA issue is big for a lot of people who invest in syndicates. Basically, in the House and Ways Committee bill, the proposal, that was released back in September, they basically came with a surprise idea that if you invested in basically any type of investment that required you to be an accredited investor through an IRA, that was going to be prohibited going forward as of 12/31/21, meaning you can no longer invest basically in real estate syndications and funds through your IRA. But if you already had those in your IRA, you had 2 years to remove it, and there was a tremendous backlash against that. I'm in some of these groups with syndicates, and they're all like, "Go write your Congress members," and they're all. I'm sure that their Congress people got a lot of letters from people on that, and then they took it out. It wasn't even there. There's no mention to it in the latest proposal, which is good news for everybody out there who invests in syndicates through your IRA.
Right. Well, that would have been a retroactive tax because they were going to make you treat it like a distribution, retroactive. So, and you're kind of toast. But yeah, so that's not in the bill that was dropped last Thursday. So you can breathe a sigh of relief if you have been investing in syndicates with your IRA. What else was in it? Conservation easements? That was a retroactive proposed tax. Those have been dropped, so that's not in the current bill. I feel like there's another big one. Wasn't there another big one?
Yeah, there was. Okay, so capital gains. The increase in capital gains tax was not in it. The increase from 37% to 37.9%. There was 39.6%. Excuse me, at the top ordinary income bracket had also been not to be seen in the bill. So those are like two things that people were concerned about. That wasn't there, and that was very welcome news.
Yeah. Well, let's talk about what was in the bill. And again, if you want a full-blown recap, we released a podcast episode today on the Real Estate CPA podcast, so you can go check that out. But let's talk about what was in the bill. So they've got the 15% minimum or alternative minimum tax for corporations. And
C corps out there.
Yeah, C corps, and they did not include the billionaire wealth tax. So that got a lot of news coverage last week, but that was ultimately not included in the bill because it was thought to be too complex to administer.
All 700 billionaires really complex.
Yeah, well, sorry, I mean, like you got to go through all their holdings, like you got to value them all the time. I can understand, but I think one of the other issues was that if you tax them while their wealth is increasing, do you give them a refund if their wealth is decreasing? Like if they lose value, that was interesting too, because that's typically how it works. So they pulled the wealth tax, and they instead put a surtax for like people earning millions and millions and millions and millions of dollars.
Yeah, I think it's a 5% surtax if you're earning $10 million or above, and then another 3% if you're at 25 million. So if you're out there, you make that type of money, that could realistically happen. But you know what? There's better ways to earn money than that. So anyway.
Know Thyself First from YouTube says, "Good evening." Good evening, sir. Thank you for joining us today. What else was in the bill? They had the wash sale rules being applied to cryptocurrency.
Yeah. So basically, anybody buying and selling crypto, if you buy ETH, which is going nuts right now, all-time highs. If you buy Ethereum and then you sell, basically, if you sell Ethereum or Bitcoin or any cryptocurrency at a loss, and then you buy it back within 30 days, essentially just like a stock, you're not going to be able to deduct that as a capital loss. It's the wash sale rule. So they clamped down on that. Not too surprising, but that was in the bill, and I wouldn't be surprised, honestly, if that does make it through the final bill if anything passes. So.
One of the other items that I saw, and I haven't been able to dig into the actual draft of the bill yet to verify, was they're suggesting the net investment income tax being imposed on pass-through businesses as well. Mm-hmm. So that would be pretty significant to anyone working in partnerships, or really if it's going to be even hitting syndications and things like that.
Yeah, it's definitely going to hit syndications, going to hit partnerships. I think who it's going to really hurt are like people that run S corporations, because if I earn like $200K in an S corporation net income, if I don't have an S corporation, I pay self-employment taxes on that full $200,000. But an S corporation allows you to like I could pay myself a $120,000 W-2 wage, and the remaining $80,000 comes out as a distribution from the S corporation. But on the $120K of wages, or I only pay self-employment taxes on the $120K of wages. The $80,000 that comes out as a distribution, when I'm running an S corporation, there's no self-employment tax there. So it's like a way to reduce my self-employment tax exposure. And so you're right, with the net investment income tax, they're saying, that it's going to be a 3.8% tax that's going to apply to every pass-through entity, every single dollar. And it'll essentially make that S corporation status a little less valuable for people that have been running it. So there's people for like, builders, flippers, wholesalers, real estate agents, that type of thing. Could potentially hurt you.
Property managers.
Property managers. Yep. And then the last significant thing in the Biden plan that was released last week was they're allocating $44 or $45 billion to the IRS specifically for enforcement. And that's a pretty significant budget increase. So, if you're watching this, the action item is really the only action. I know we did this on the podcast too, but we'll do it here now. But, we start this by saying what you need to do right now to save money. You don't need to do anything right now to save money because it's a pretty vanilla tax plan for most real estate investors. But if you did take one action, the one action that you would take is reviewing your prior 3 tax returns and just making sure that all your T's are crossed, all your I's are dotted, because the IRS is going to be ramping up. If this passes, I would imagine that audits would ramp up probably Q3, Q4 of next year, of 2022. And you just need to be prepared. You don't want to be the person that's caught with their pants down when the IRS comes knocking, right? You want to have your facts and circumstances structured up front now. Yeah. Just don't.
You want to document everything. The first episode of the Real Estate CPA podcast by Brandon, I'm pretty sure, was document everything. And, that's what it's going to come down to when you get audited by the IRS. If you don't have proof, then it didn't happen. It did not happen. And that's what they're going to care about. So document everything. Keep yourself prepared, because you know what? If they come knocking on your door, you don't want to be caught, like Brandon said, with your pants down.
100%.
It's the social media rule, if you don't have a picture, it didn't happen.
Yeah,
exactly. That's the IRS says picture didn't happen.
All right. So let's transition. Actually, I want to talk about something before we talk about the $25,000 passive activity loss. But while we transition here, what?
I was going to say, I totally forgot we were going to speak about that, but sorry.
Totally forgot what?
I totally forgot that was the topic of the agenda.
Oh, yeah, it's okay, man. The bourbon's it's flowing, man. It's good. It's good. So Christopher asks, I learned like 5 or 6 years ago, I went to this, I was working for, I think, Ernst & Young at the time. Gosh, that would have been 7 years ago. I was working for Ernst & Young, and I went to this diversity seminar, and the guy said that he was an African-American guy, and he said white men typically just go right to your nickname without asking permission first. And I was like, dude, I never thought about that. So Christopher, since I can't ask you if I can call you Christopher, thank you for asking. What whiskey do you guys drink? Off topic. No, it's totally on topic, Christopher. It's totally on topic. I'm drinking 4 Roses. Oh man, am I drinking small? I think I'm drinking small batch select right now. Not my single barrel. Single barrel is my go-to choice.
All right, I'm drinking Maker's Mark, which is maybe not real bourbon, but it is clearly whiskey. If you can't tell. And by the way, if you zoom in a little bit, it says bourbon. See right here, where it says it says it. It says it. Sorry, I can't get this right. There it is, bourbon. See?
There you go. Yeah, I'm even worse because mine just says whiskey. It doesn't say. I don't think it says bourbon anywhere on there. But to be honest, I'm more of a Scotch guy myself. So,
Scotch is, man, I can't. Mad respect. I can't stomach Scotch. It's good. All right. So let's talk. So in the Facebook group, TaxSmart. Oh man, I lost it. In the Facebook group, TaxSmart Real Estate Investors, there was a post. I'm just going to find it real quick.
It's one of the
What?
comments. Tom always looking for the loophole.
That's what he said. Yes. Yes, he is. This is what we're laughing at right now. Yeah, Tom's always looking for the loophole, man. Oh, and he said Mint Thomas. See, everybody's learning tonight. This is great.
You call me
Anybody,
Tom.
yeah, you can call Tom. You can call Tom. What was that episode that we did on the Real Estate CPA podcast that one time? It was a while back, but we were talking about how you needed a spouse to qualify for real estate professional, and it was like a dating ad.
Yeah. Listen. If you're out there, you're on Facebook, maybe whatever. Look, I work full time as a All right, we're not going that far.
No, you go. I'm just telling everybody else, like, don't do it.
Oh yeah,
don't do it.
No, look, if you're out there, you're a real estate agent, you're a full time real estate investor, you're a property manager, you work full time in a real property trade business. Let me know.
That's the criteria, folks. Oh my gosh.
You check 75% of his boxes. Yeah.
If I go on a date and they say that I work in any other industry but real estate, I just cross them off the list. Deal breaker.
Oh my gosh. Oh man, that's great.
Kidding.
All right. Okay, so let me see if I can find this post. So there's a post in TaxSmart, the TaxSmart Facebook group, that said, my CPA is telling me that in order to take advantage of cost segregation and depreciation, the property has to be purchased under an LLC, not my personal name. And then, and of course, that's not true. You can cost seg anytime, anywhere. It doesn't matter how you own it. You can always cost seg it. But then there was like this thread that kept going that was like, when can you take the losses against your W-2 income? And there were some people chiming in saying, I understand that reporting on Schedule E allows you to take it against your income versus Schedule C or vice versa. I might be reading that too fast right now. And then I think somebody said, it seems like if I'm paying them what they want, then they should know what they're doing. Yeah, just comments on like, CPAs maybe not knowing exactly what's going on. So just kind of wanted to talk about that and add some clarity there. You can cost seg anytime, no worries. Yeah. It doesn't matter how you own the property. You can cost seg after you sell the property too. I don't know, not many people know that. You can cost seg after you sell the property. So you can really cost seg anytime.
You have to report it though on the tax return where you still own the property, right?
Right. Yeah. So it has to be the same year. But yeah, the question really is like, okay, if the cost seg creates a big tax loss, can I claim the tax loss? And you can claim the tax loss if you qualify as a real estate professional, because, well, you can claim the tax loss if you successfully move the rental loss out of the passive bucket and into the non-passive bucket, because every single dollar that you earn of income is going to go into one of those two buckets, passive or non-passive. And that's your W-2 income. That's going in the passive bucket. Non-passive. Business income, non-passive bucket. Interest, dividends, capital gains from stocks, non-passive. But like rental real estate, that's passive by default. So how do you get it out of the passive bucket and how do you get it into the non-passive bucket? Because if you can't, then any rental losses are just suspended and they're carried forward because they're passive. Passive losses are suspended and carried forward. So that I think is the real question as to what they were all asking. But yeah, you just qualify as a real estate. I mean, you just qualify as a real estate. Everybody's they're laughing because they know it's hard.
Look. I just want to say this though. Look, everybody out there who thinks just having passive losses is not good is wrong, because for the last 2 years, I'm coming on 2 years now, where I'm gonna have, and I know the rules, right? And I know the game, where I'm gonna have a tax event due to not having enough passive losses. So everybody out there who thinks that real estate professional is the cream of the crop and that everything is BS if you don't have the real estate professional status, excuse me, you're wrong. You're wrong, and I'll tell you why you're wrong, because I'm going to pay taxes because I've not invested and do not have enough passive losses. So passive losses are, I might. There's still 2 months left in the year. But having passive losses is not necessarily a bad thing. I'll tell you that.
Yeah.
Actually,
I think that, you know, where I get it kind of phrased in a different way a lot of times is just that, you know, it doesn't benefit me at all to have a cost segregation study done because I know I'm not going to meet real estate professional status. And I still say yes, because in a real simplistic example, you know, you've got $100,000 property and maybe there's $20,000 worth of property that's bonus eligible. If you hadn't done that cost segregation study and you're just using standard straight line depreciation, even if you bought that property on January 1st, you know, you're looking at only about a $3,500 roughly depreciation deduction, you know, versus upwards of 20,000, maybe even a little bit more. And if that's more than enough to wipe out your, you know, all of the taxable income that you otherwise would have had from the rental, that's great because you just got all that cash flow in year one, completely tax free, essentially. And chances are you're going to have a good amount that's going to carry over to year two and maybe year three. So, you know, instead of getting that $3,500 deduction for the first, you know, for the 27 years, you know, you may have this built up to where the first 2, 3, maybe even 4 years, all of your excess cash flow is completely shielded from taxes, which, you know, and then if you amplify that up to 2 or 3 properties, how much is that going to potentially open you to acquire a fourth property in year two instead of only being able to do 3? So yeah, it's typically always going to be to your benefit.
Nailed it. Yeah, I mean, it's a concept that I try to teach in the TechSmart bootcamp that we're running right now. It's a you know, we just wrapped up real estate professional status last week, and we're doing short-term rentals this week. And you know, a lot of people are asking about the non-passive losses and being able to juice those and make them better. And something that I teach in that bootcamp is, you know, that's great if you can, but it's not the worst thing if you can't, because it just gives you flexibility. You know, every year, if I know, now you got to know what your suspended passive losses are, right? A lot of people don't know what their suspended passive losses are. Like if I asked you right now, not like you guys, because I know you guys know, but everybody listening, if I asked you, yeah, what are your suspended passive losses? Where would you go to find that? They're somewhere in your tax return. You can find them, and a lot of people don't know. Now, if you know, if I know that I'm carrying forward 200K of suspended passive losses next year, then it just helps me with decision making. Maybe I don't have to do a 1031 exchange. I can just sell the property outright. I don't have to worry about that because I've got all these losses that can offset. So you have to know where this stuff's at in your tax return. It's really easy to find. You just got to be pointed in the right direction. So yeah. Anyway, so real estate professional status. That's one way to move out of that passive bucket and into the non-passive bucket. Another way is to have short-term rentals. You know, you have to materially participate. But a third way is to earn less than $100,000. What were you going to say, Tom? What's the third way?
That was exactly what I was thinking.
That was it. Oh, you looked a little disappointed when I said it.
I'm sorry. I was
What's
more
Tom's
like, I'm sorry. I was like, oh yeah, that's the way. You know, that's that.
Oh yeah, got it. Like that's the way. Okay, got it. Like ding, ding, ding. Sorry, my bourbon's getting to me too. All right, so $25,000 passive loss allowance. That's another way to use some of your passive losses. So if you earn less than $100,000, and if you earn less than $100,000 and you actively participate in your rental and you own at least 10% of your rental activity, then you can claim up to a $25,000 loss allowance from your rental activities, regardless of whether it's passive or non-passive. You can just claim this loss allowance. You can't use short-term rentals though. So short-term rentals are excluded because short-term rentals are not rental activities. Right. Rental. I'm trying to get in frame. Rental activities under the code or under section 469. So this $25,000 passive loss allowance only applies to rental activities, of which short-term rentals are not. But you got to own 10% of the activity. You have to be actively participating, which basically just means making management decisions. You don't have to be the manager. You just have to be hiring the manager, which most landlords do. And you got to earn less than $100,000. Now, as your income goes above $100,000, that $25,000 passive loss allowance starts to phase out. And it's fully phased out once you reach $150K. So sometimes we get clients that'll be like, oh, I'm going to drop my income to $149,000. And then I'll be able to take the $25,000 passive loss allowance. And we say, What is it, Tom?
500. You take like $500, right?
Yeah, it's $500. That's the allowance. $24,500 has already been phased out if you earn 149K. So it's a phase out. It's gradual. Yeah, but I was going back and forth with this this tax person in this other Facebook group, and it was like, I think it's Build Short-Term Rental Wealth or something like that. Is another one of those short-term rental Facebook groups. Going back and forth with her, and she was like, well, you were not professionally trained. I'm curious to what your training was. And I was like, well, I wasn't professionally trained. I mean, I started at PwC and Ernst & Young. I did that. That was consulting. It wasn't tax, but I've been running this business for 6-7 years, and I've hired a lot of really smart people, and I love reading the tax code and tax court cases. And we've helped 700 investors, multiple audits successfully. I'm like, I feel like I know what I'm talking about.
I will tell you this, Brandon knows the tax code. He knows the tax code because he makes me have to know the tax code. I have to know the actual citations. I can never post anything and make an argument without knowing. So I'll tell you right now, Brandon knows the tax code.
That's true. Yeah, I always ask Tom where his citations are. Not just Tom, everybody in our firm, because I pride ourselves on not spewing BS.
No, for real.
Yeah, so just trying to be objective. But yeah, it's so funny, man, going back and forth with this person. She starts throwing out this training thing, but then she was like, short-term rental, you can take the $25,000 loss allowance for short-term rentals, and you have to materially participate to take the $25,000 loss allowance. And I was just like, no. And I was trying to say it really nice, and I actually typed up multiple comments, and then I went and I posted one, and I went back and edited it because that was the nice comment, but I tried to make it even nicer. Like, hey, you're wrong. You don't know what you're talking about, and this is bad because you're holding yourself out to be this tax person that knows what they're talking about. But it just kind of made me wonder, what in the CPA industry, man, it's like people are always at each other's throats for some reason. I don't understand it. It's just kind of weird. we can't all be collaborative. We gotta people feel like they gotta one up each other in these groups. I saw it on Bigger Pockets too, man. It was like that. It was just it was ridiculous.
Yeah,
we're on the same team. We're all trying to help people save money on taxes. That's
right.
The bottom line.
Yeah.
Right. Yeah, I mean, I'm I don't know, man. Somebody comes to me and they ask what my citation is, or if they have a different way of doing it. I'm totally open to learning, because then I know, dude, I got 700 clients I can go pitch this to. This would be awesome. But it's not like that. It's not. I experienced that in that group, and we were going back and forth. And I was like, yeah, here's the actual code citation that explains how this rule works. So I linked up to the Cornell website, and then she was like, well, you don't have good training. And I was like, okay, but I have citations.
But I've read the tax code. Have you read the tax code, honey? I'm sorry.
Well, no, I'm not trying to be mean. I was not trying to be mean. I was just trying to point her in the right direction without,
yeah.
But then I did break her comment down though, and I was like, yeah, so this is incorrect. This is incorrect. This is how it works. Because eventually I was just like, okay, this is going nowhere, and everybody else that's watching this at this point is now confused as to who's right. And so I was like, all right, well, citation, tax court case. Yeah. And that's what I do on Sunday nights. What do you guys do? Yeah.
Anyway. Yeah. I've got, I've got a copy of the passive activity loss audit technique guide on my nightstand. It's like sleeping under
print it all out.
Bring you good juju.
Yeah.
Yeah.
Exactly.
The passive activity loss audit technique guide. Tell everybody about that, Justin. What is that?
Yeah. So I mean, it's literally like a user manual, or a handbook that the IRS provides to its auditors and says, hey, this is basically the playbook on when, if you've got an audit involved with somebody claiming real estate professional status, or erroneously claiming passive losses as non-passive, things of that nature, and gives them insight on this is how you want to pursue with basically fact checking the taxpayer, and it's kind of almost like a plan of attack. So it's kind of unique in that, we get this insight into more or less the tactics that we know they're going to employ when you're being audited. So it's great contextual, essentially evidence or information to be able to figure out like what's in the mind of the IRS and an IRS agent and what they're going to kind of look for when they're auditing you. So and it's publicly accessible. I mean, there's a lot of stuff around audits that I think we get questions on a lot where people say, what are my chances of getting audited if I do X, Y, Z? And a lot of that information is very closely guarded, but these audit technique guides are the most transparent, I guess, view that you could probably get into that process.
Well, I'll say this. Look, there's 45 billion. So we say 44, but it's really close to 45 billion going into IRS. The IRS coffers to hire more people to audit you, right? Not Justin, not Brandon, not me, maybe. But but they're going to try to audit
the loopholes.
Tom
get audited.
They are going to try to audit people, and it's public information what they're going to audit you on. And we try to tell people all the time, like, hey, look, this is what the IRS is looking for, and we're trying to help you guard against it. We're not the bad guys here. We're trying to help you help yourself not get that in the event, of an audit, that you're protecting yourself, because this is what the IRS is looking for. And all you have to do is Google the IRS Passive Activity Loss ATG, and you'll be able to pull up a PDF, essentially, of what they're looking for. And that's what they're going to come asking you, right? Mm-hmm. And you want to make sure you have your act together. And that's what we help people on all the time, making sure that they have everything in order so that if, God forbid, knock on fake wood here, that the IRS comes and audits you, that you have your ducks in a row, and then the IRS audits just bang, bang, bang.
Yep. Yeah, so the audit technique guide's great. It's written in layman's terms, so it's much easier to understand. And they have tons of citations, tons of tax court cases, so it's good stuff. Just understand, though, that it's the IRS's position, and that might not necessarily be the tax court's position. That's the only caveat. But we love the audit technique guide. We use it in presentations. We use it in the Tax and Legal Summit. We use it in the boot camps that I'm running. It's great. Thanks for bringing that up, Justin. That's a really good resource for folks. Now, before we close out, I've got another Facebook user here. I'm going to share here. So Bigger Pockets posted a new episode today stating the concern over the IRA investing in LLCs. Are you sure that's not a thing anymore in the last bill? Yes, I'm sure. The last bill dropped Thursday. We read not only the summary, which you can find. Can we actually share that, Tom?
The summary, the link of the podcast.
Yeah, I think
I happen just to have it pulled up right in the next browser tab.
Link. Yeah. Well, no, I was. Yeah, I mean, link the podcast up, but I was going to share. Here it is.
Oh, the actual bill.
Yeah, I'm going to share the actual the summary there. That looks like that just went out to YouTube, so that didn't work.
So, how? My question is, how did you share that? Because I see a private chat. I can share with a private chat.
Oh, I have a message thing.
Oh, I see. Okay. I see that.
Okay. Okay. So in the bill that dropped last Thursday, there was nothing about the IRAs. It was all removed. Now, the Bigger Pockets podcast episode, I actually pulled it up because I was like, wait, what did they know that we don't? And they do have a note. They have a disclaimer that says, since this episode was recorded, things have changed. So, and I think that they re-recorded the intro or something to update it. But yeah, not in there anymore. Should be good to go. I think there was some IRA provision or something in there, but there wasn't. It was not related to the syndication stuff that was driving everybody nuts 2 weeks ago.
I don't even know where that came from.
Here's the link. There you go. Oh yeah, there you go. So you can stop this recording later, and you can type that link in, and that will give you the summary. If you really want to type it all in, that will give you the summary of
what could
the
go
bill.
wrong.
Right. There's a lot of stuff in there, but that'll give you the summary of the bill. If you start on page 125, I think is where the tax changes start. So go check that out, or listen to the Real Estate CPA podcast, the most recent episode that we did today. We filmed that this weekend, so it's updated. It's the latest update on legislation.
And this episode 157. And by the way, for everybody who's listening, sorry to cut you off, but Justin also has episode 153 of the podcast. So if you want to learn more about Justin, check out episode 153.
Yeah, especially if you're thinking about becoming a client soon. You probably want to learn about Justin. So, I think that's about it. So here's the link. You can go read the bill. If you want the massive bill text that's floating around out there too, you can grab that. If you want to read the actual code changes, which is way less exciting than reading the summary. But that's it, folks. Thanks for jumping on. We really appreciate it. Like I said, we do this every Tuesday, 7:30 p.m. Eastern. So mark it on your calendars. We just kind of riff about different tax things that we see and periodically answer questions. I know there were a lot of questions from our YouTube folks here, and we didn't have time to get to those today. But we'll do some more Q&A and make sure that everybody gets their questions answered over time. But thanks so much for joining, and we have a good night.